Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options US Market Update. In the last update, we focused on the yield curve and the fact that we've now inverted twice. Anytime you hear in the financial media, oh, quote, it's different this time, you have to be careful and wary of that because it's never different this time, especially now that we've had two separate inversions. But we did also talk about that doesn't mean that we may go into recession next week or next month. It's looking forward 9 to 12 months down the road. So that's something that we want to think about. So what I want to do in this update is focus on interest rates and try to highlight for you why interest rates are so important to the equities markets, because they are, especially when you're dealing with the kind of debt that we have here in the US. Interest rates determine how much it costs to service the enormous amount of debt that we have in the US. So let's get to the charts and I'll show you what I mean. First of all, taking a look at the S&P 500, a lot of people have been trying to surmise back and forth. It seems like the market moves on any tweet that comes out from President Trump and trying to figure out where things go. There seems to be a lot of concern about whipsawing. One day we're up, one day we're back, and the whole market is hinging on what's going on with the trade skirmish, as President Trump calls it, or trade war, as the financial media likes to use because they want to sensationalize everything. But when you take a look at the chart, Elliott Wave is just saying this is normal. There's nothing unusual going on here. Maybe the trade war is a trigger to move it, but this is what I've been talking to you about for many months, is the fact that when you look at technical analysis, the news that comes out seems to just mold in with what the technicals were really telling us. And when we look at this, we've got a wave 4 that's only corrected 29%. We haven't even made it down to that 38.2% level. So there's no concern here. In my mind, again, this is nothing more than a bounce down from the previous highs in the wave 3. So if we hold here and continue higher, in my viewpoint, we're still technically in a wave 3. We haven't even had a wave 4 correction yet. We got to get down to that 38.2% level. But again, nothing unusual going on here. Normal course of technical analysis in the markets. Look how long this run was. I mean, to have a run this long without even a 23.6% correction was phenomenal. So we are due for at least some sort of pullback, and coming in at the recent highs was a perfect opportunity for that. Now, is it convenient that the China trade war has given the reasoning or an excuse, if you will, for some people to take some profits? Absolutely. But that's all we're doing here is we're coming in and having a little bit of a pullback, and now we're resetting. And as I've mentioned, and I still maintain my view, that at some point we will make a meaningful break of those highs because we need to have something to pull in that retail money that's been on the sidelines. And until something shows different, I will still maintain that view. But what a good technical trader does is adjust to the market, adjust to what the charts are telling you. So if the charts change, then I will have to adjust my view as well. But I don't trade based on what I think is going to happen. I trade based on what the charts are showing. And then I have historical background to back me up on what's happened historically. That's one of the beauties of doing this for over 20 years, is that you have some experience. So you have to draw on your experience, but don't sway from the charts and don't try to make the charts fit what you think's going on. A big mistake that a lot of people make is trying to make the charts fit what they think is going to happen. And when you do that, you're trading with your own emotions, and it's never a successful thing. Trade what the charts are showing you, take your emotions out. So with that, the S&P looks fine and normal, and we're trying to crawl back up. We'll see what happens over the next few trading days. Looking at the VIX, we had that volatility from the news out of China and the tweets and all that. So it's nice to have the extra volatility in the market. We love that as option traders. This is nothing severe in any way, shape, or form. I mean, we're not even close to having the volatility that we had just back in December that started off this last big run. So there's no cause for concern over this volatility. In fact, it's welcomed. But let's get to the chart of TBT and interest rates, because this is what I wanted to focus on is in this update, is the fact that interest rates have gone back down. And now we are back at the lows And if you wanted some historical precedent, we're at the lows of interest rates that we haven't seen since going all the way back to here, which is July of 2016. So these are the lowest rates we've had for 3 years, 3+ years. So interest rates are on the low side, and as long as interest rates stay low, then the equities markets are happy and they have the ability to move to the upside. So why does the market, why are equity markets so tied to interest rates? Well, a lot of it has to do with the amount of debt that we have. And I'm going to actually show you the debt clock here in a second, which will probably shock you if you've never looked at a picture of it. But as long as rates are low, it doesn't cost us as much to service our debt. And then that allows room for expansion. Now, our GDP is running around 3%. It's been a little bit above for the first time in a long time. So first time in over 10 years, we've actually had a print of a quarter even with GDP above 3%. And now a year above 3%. But as I've mentioned, 3% is that's the goal. That's the milestone that we need to show that we have enough growth to outpace inflation. And that's one of the big reasons why equity markets don't like rising interest rates. When you start to see rates rise, it usually is an anticipation of rising interest rates. Now imagine this scenario. We have a pattern of rising interest rates, and then the economy begins to slow and may move into a recession as advertised by the fact that we've had 2 inversions of the yield curve. Well, now you're starting to get into the worst of all worlds. We can deal with deflation, we can deal with inflation, but when you get into something known as stagflation, that is a huge problem for the equity markets. And stagflation is when you have slowing growth and rising inflation. So you have both of those going on at once. So you have stagnant growth and inflation. So that's why we want to keep such an eye on interest rates, and that the equity markets are okay. They breathe a sigh of relief and they feel good about things when rates stay low. We're a long way from interest rates starting to rise and cause that kind of anxiety in the markets, but with the fact that the yield curve is inverted twice and the fact that we likely will have slowing economic conditions 9 to 12 months down the road if interest rates start to move back to the upside, and we do know at some point they're going to at least go back to here, but that's no big deal. But if they start to go all the way back up to here and higher, then we have to become concerned. Because I don't know if you've ever looked at the debt clock, but here it is. Over here in the top left where it says U.S. national debt, $22 trillion. I mean, that's amazing. And look how fast that debt clock is moving. If that doesn't freak you out, I don't know what will. And then you come down and look at U.S. total interest paid, how much the servicing of the debt costs us. So you're watching all these things just tick away constantly as fast as the clock can go. And that's how we are going further and further and further into debt. Literally every millisecond, you can see for yourself how fast the debt is ticking off. So at some point, this is going to come to roost. At some point in time, unless we can figure out a way to get our economy to grow 5 or 6%, so we get a GDP of 5 or 6%, we're going to have to pay the piper on this debt at some point in time. And likely that'll come when interest rates rise to the point where we're no longer able to service that debt. Now, there's been discussions on China may use their, quote, nuclear option of actually starting to dump the treasuries that they buy, because they, along with Japan, are the 2 biggest buyers. They really can't afford to do that without collapsing their own economy. But if they stop buying, which we've talked about that in the last couple of recordings as well, that could have an effect on interest rates, and we'll see. But we're going to keep a close eye on the chart of interest rates and see what happens there. And again, if we start to see something moving back to the upside in these rates, then we're going to have to start to become extremely cautious in the markets. Or if you're not doing that, then you're setting yourself up for taking way too much risk. Hope everybody's had a good week. Be back to talk to you again next week. Take care, everybody.